Hairston, and I am your host, Mark Hairston, where every week we come on the radio and we share some ideas on hopefully how we can help you save money when you're buying a property on your mortgage or how to maintain your property long term to keep its value. So that's what our goal is. And this topic today, I'm going to talk about credit and the value of good credit and a little bit about the credit system and how it works because this is a really big part of what we do as mortgage lenders. There's three primary things that we look for. We look for income, obviously, and we look for debt, we look for cash assets, and we look for your credit score. And your credit score is a very, very important part of the mortgage process. And I want to kind of talk about that, pull the curtain behind it, because it can be a mystery on some level. And so I want to share an example of the value of good credit. I had a gentleman who had read my guide. I wrote a white paper called The Truth in Lending. And he had asked me for a copy of it. He was a prospect at the time. His name was Greg, and he was shopping for a mortgage as I told him to. And he was talking to different lenders and didn't want me to run his credit quite yet before he decided to use me. And he applied with me, and he had told me that all along his credit scores was over 800, which is really high. I'm thinking, well, then that's good. Well, we ended up actually running his credit. It was 767. No, I'm sorry. It was 776, 776. And 780 is the top tier, if you will, the top benchmark for the best rates. And I said, well, Greg, you told me it was over 800, but it's not. It's actually 776. You're 4 points away from the best rate. And I'd already quoted him a rate. So I said, here's what we're going to do. In analyzing his credit, he had a credit card that had about $11,000 balance. I said, look, if you can pay this thing down to $2,000, then we'll rescore your credit and you'll get a better deal. Well, that's what he did. We ran it through the credit bureaus. He got a 790 after that, and we saved him over $1,500 in 4 points of credit score. So sometimes that is the value of really good credit. So let's start kind of at the beginning or the basics. There's three credit bureaus in the country. There's Equifax, there's TransUnion, and there's Experian. So all three credit bureaus are independent. They're not government agencies. They're independent companies. And their job, or what they do, is they collect data from all sorts of lenders out there: mortgage companies, Visa cards, student loans, car loans, whatever debt you may have is normally reported to all three bureaus. So typically everybody's going to have three different scores. It could be 740, 760, and 780, something like that. And the mortgage companies always use the middle score when we're identifying or pricing out a mortgage. So these companies are regulated on some level by the Federal Trade Commission, which means that there are certain rights as a consumer that you have. And those rights are typically three areas that you have rights to as far as somebody reporting your credit. They have to report it timely. They have to report it. They have to be able to verify the information, and they have to be 100% accurate. So if any of those three things are off, you can get your scores changed. In matter of fact, in a couple of weeks, I'm going to have a woman who's a friend of mine that specializes in the credit repair. As a mortgage broker, I don't do credit repair. I can help people increase their scores, but I don't actually argue with the bureaus on different topics that may be on somebody's report. So credit repair is very legal. People ask me all the time, is credit repair legal? And yes, it is, because you do have rights as a consumer that the bureaus have to do those three things. They have to report your credit timely. They have to be able to verify it 100%. It has to be 100% accurate. So if any of those things off, you can certainly get your scores changed. So let's kind of talk about what's in a credit report. Number one is your identifying information: your name, your address, date of birth, employment information, where you've lived, et cetera, et cetera. Also, trade lines. A trade line is a line of credit. Could be a mortgage loan or a car loan, or it could be a student loan, could be a credit card, personal loans, whatever. There's two types. There's installment loans, which are fixed payments, like a mortgage loan over 30 years. It's the same amount every month for the most part. Or revolving credit. Revolving credit could include a HELOC loan on a property, possibly, because it is a line of credit, or a Visa card or Sears, whatever you have. And they're gonna look at all that data, and it changes all the time. So in this case, with my client, We were able to rescore his credit in about 4 days once he paid that card off, because we verified it through Chase and he paid it down. We took that information to the bureaus. In about 4 days, his score went up about 15 or 16 points. Okay, that's very, very valuable. Also, credit inquiries. A credit inquiry is when somebody comes to me for a mortgage loan, and it's called a hard inquiry. It means they're coming to apply for credit, a line of credit. Now, a soft pull is what I can do for people who don't want to do a hard pull yet. And a soft pull means it doesn't show up on your credit report, but it gives us enough information we can pre-qualify somebody. I just can't close a loan with a soft pull. A hard pull is required in order by Fannie Mae in order to close a loan, but a soft pull gives us enough information to get somebody pre-qualified. We run a lot of those. Also, public records. Anytime you may have a bankruptcy or a foreclosure or a judgment, those things are showed up in public records because they're public information. And that's the first thing I usually look at. Is there anything in the public records? Because if there is, that's going to be a challenge. Like if you have a judgment or a tax lien, those things have to be cleared up before you can get a mortgage loan. Now, bankruptcies and foreclosures have their own situation as far as underwriting. But if you've been out of bankruptcy for a couple of years, FHA most likely will help you get a mortgage loan. Okay, you can't do it the next week, but after a couple of years, you can. And finally, any collection items. Collection items won't kill you, but they do show up. So you haven't made a car payment, or you had a car repossessed, or you had a credit card go back, it will show as a collection item. And so typically, credit companies, or not credit companies, but the bureaus themselves will keep your data for about 7 years, unless you're still using it. Like I have a Dillard's card that I've had since 1990. It still shows up on my credit report because I use it occasionally. And I tell people, don't close accounts if they're good accounts. Keep them open. Some of the gurus out there and talk about close all your credit card accounts. That's not wisdom, because eventually you're probably going to need a score. As an example, I had a young couple who follow the Dave Ramsey methodology, and they're very qualified to buy. I mean, they both got good jobs. They both got good incomes. They've got plenty of money down, but they don't use credit. And the wife had one credit score at a 3, and he had none. So if she hadn't had a credit score, I couldn't have got him a mortgage. Now, they could have built credit, but not in the time it would take to close the loan. So I tell people, always use credit cards and pay them off. Get an Exxon card, get a Visa card, go get something to eat, go buy a dinner and pay the thing off. But that way the credit bureau has something to read. If you don't use credit, the bureau's, the FICO system has nothing to read, so they can't give you a score. And without a score, it's going to be hard to get a mortgage, I'll tell you. And so typically public records like a foreclosure or bankruptcy may stay on your record for 10 years. It doesn't mean we can't help you get a mortgage, but it'll still show up. And after that, it's supposed to fall off. And so what factors are not included in your credit report? They're going to be your race or color, religion, gender, marital status, age, or salary. Those things don't show up. So that has nothing to do with your FICO score. And we're going to talk about FICO in just a minute. But as an example, I had a physician one year, this a couple of years ago, apply for a mortgage, nice size loan. And his credit scores weren't very good. They were like 640. He was trying to get a jumbo loan. He was trying to get over $1 million mortgage, and I couldn't help him at the time. He said he made all sorts of money. He tried to argue that because his salary was so high, that he still should get a mortgage loan. I said, well, that's not really quite how it works. Now, we were able to help him get over 700, but it took about 3 months. So he had to wait a few months and work on his credit score in order to get it up there. But just because he made a bunch of money doesn't mean you're going to have good credit. And so what's the cost of a lower score? In my world, in the mortgage world, on the government loans, the FHA and VA loans, we can go down to 580, and that's about as low as we can go. On conventional financing, it's usually around 620. And when we're going to talk about the FICO model, that means Fair Isaac Corporation is the company back, I think, in the 60s who actually developed this analysis of credit. And they've been using credit scores for a long time. And they range anywhere from 300 to 850. Now, I've never seen a 300, and I've never seen an 850, but I've seen a lot in between there. So 580 is sort of the minimum that lenders will use on the government type loans in order to get you qualified, 620 for conventional. Now, lower scores also typically are going to have reduced open lines of credit. It's just harder to get credit with the lower scores, credit cards, et cetera, et cetera. Higher deposits for rental. If you're going to rent an apartment or house, they may require more money as a deposit because of scores. Insurance costs could be higher. So if you go shop for a homeowner's policy, they're going to run your credit. Then they may have a soft pull, but the higher the credit score, the better your deal is going to be when you get to, home insurance, as an example. Increased cost of mortgage insurance, and certainly increased cost of interest rates. And we'll talk about that and the cost of that, because loan amounts in Austin are so high. If you have a quarter or half a rate difference, that could make a change of thousands of dollars over time in your budget. And so let's talk about what a credit score is. What exactly is it? It's an analysis. A credit score is a 3-digit number based on an analysis of a person's credit file and credit worthiness. That's basically what it is. And again, its ranges from 300 to 850. Now, the reason credit scores change from Equifax to TransUnion or Experian, they're never the same. They're typically always going to be within 10% of each other, but they're never the same. And the reason is it's called risk factors or scoring factors. So there's about 30 different things that these companies look at on your credit profile in order to get you a score. And we're going to talk about this more specifically, but they don't use the same scoring methodology. Equifax is going to be different than Experian. So they're going to be different. That's why we always use the middle score. We don't average 3 scores. We simply use the middle score, and all lenders do. This is not just my group, but Fannie Mae, those are the guidelines for getting a conventional or getting any mortgage, is use a middle score. And in terms of a married couple, we're going to use the lowest middle score of whoever's on the loan. So sometimes if somebody comes in and they're married, and then let's say the husband's at 780 and the wife's at 720, if he can qualify by himself, we're going to just use his, because she's going to drag down, or the rate will be higher because we have to use her score. So sometimes we're going to do what they call a non-purchasing spouse, where one party will be the primary or the only borrower. Matter of fact, this couple that where he didn't have a score, I had to take him off the loan because they won't allow any parties not to have a FICO score. So she qualified by herself. He'll still own the property. He'll still take title of the property. He just won't be on the mortgage. But I told him, I said, Zach, you really need to, use credit. He had some old credit on there, and it was all good, but it's all been paid off for over, 2 or 3 years. So that was a challenge for him. The other thing that happens as far as credit models is not every creditor is going to report to each bureau. So let's say you had a car company, car loan. They may only report to 2 different companies, let's say Equifax and TransUnion. If the other credit bureau doesn't have that data, that's not going to show up in their model. So that's why their scores are going to be different. Now, if you have huge fluctuations, let's say you have a 750 and then you have a 650, there's something going on with that 650. Something's being reported there that needs to be looked at, because the others aren't seeing that. So if it's over maybe 25% difference in score, then you're going to want to check that out for sure. And so score talk in my world is anything over 780 on the FICO model. Again, the FICO model is all we use, all lenders use, period. There's other scoring models out there we're going to talk about in just a second. But 780 is the top tier. And then it's tiered 760, 740, 720. So as you go down the scale, and I'm talking specifically about conventional financing, not FHA or VA, a 650 FICO score on FHA or VA and the 750 gets you the same rates, but conventional, it doesn't. So if that's what you're looking for, you really want to work on getting your scores as high as possible. Anything under 700 would be considered good credit. Under 660 would be fair credit. And under 620 is probably not, I would say questionable, but it's marginal. We can still help you, but you have to have a much stronger profile than you would if you have, when I say profile, I mean, you may have to have some reserves after closing, things like that are going to support the loan. It could be approved, but they may want additional, what we call additional factors. And so, so credit score basics is going to be around, if you have this credit for at least 6 months, you'll have a credit score. So when kids are getting out of college, possibly, and their parents haven't put them on any credit of theirs, then if they're out of college, they may not have any credit. If they apply for I usually tell them to go get an Exxon card or a gas card or a Capital One or something with a low amount of limit, but start using it and use it and pay it off or pay it down every month. and keep it consistent. Maybe get 2 or 3 of them, and you'll have a credit score within, 6 months. It doesn't take forever. The other thing that we can do is, it's called an authorized user. So in this case, let's say a young man or woman out of college doesn't have a credit score. Their parents, as an example, could put them on their credit cards and make them, it's called an authorized user. Their data will flow down to their social security number and they will have a score very fast. Matter of fact, I did a loan last year for a veteran who didn't have a FICO score. He'd never really used credit, but his wife did. She had about 3 lines of credit and they were all good. But we were doing a VA loan for him, and VA required that we have a credit score. So I said, look, we're going to put you on your wife's credit scores, which they did the next day. In about 30 days or 60 days, I forget now, he got a FICO score, was well in the 700s. So that's called an authorized user, sort of a way of tricking the system a little bit, but it does work. And a credit score is calculated every time it's pulled. In other words, with my client who I ran that report for, one day was the 776, and about a week later, we pulled it again, and it was 790 or something like that. It went way up. Okay, so every time you pull credit, it changes. It's a very fluid system. So every time something changes on your credit report, which is every time you make a payment or make a charge of something, your credit score would be different the next day. Also, married people do not share a score. So people think, well, if we're married, we have been for 30 years, we'll have the same FICO scores. It's very unlikely that's going to happen, because somewhere along the line, one of them had probably had a different credit card or something like that. That's going to be close. And I've only seen it the same one time in my whole career. So it's a very unusual that a married couple would have the same score. And again, mortgage companies use the middle score when identifying or rating you as far as getting a mortgage loan done. And so again, we've talked a little bit about risk factors, and risk factors are things like, a big one really is your amount that you owe on your credit cards relative to how much credit line you have. So in other words, if you have a $10,000 Visa available credit line and you owe $9,000, that's going to hurt you. What they like to see is typically a 20% or less credit to the limit. So in this case, $2,000. If you had a $10,000 line, that's going to optimize your score. Obviously, as long as you pay it regularly. That's called a reason factor or a risk factor. And there's 30 of these that show up, but that's probably the biggest one right there. Well, the biggest one actually is going to be, do you make your payments on time? Are they on time? And there's no late payments. And a late payment is considered a 30-day late. So if you had a mortgage payment due on August the 1st, which happens to be this month in 2023, and you paid it August the 20th, that's not considered a late payment because it's not 30 days late. They call it 30 days. So if you paid it in September, your payment, you'd be dinged as a 30-day late, and that's going to lower your scores quite a bit. It could lower your scores 50 points, really, literally overnight. So number one thing they're going to look at is how you make your payments. Now, there's another thing that shows up regularly in my world as well. And it's called a Vantage score. And people call me and say, well, Mark, I have looked at my credit. My credit scores are 720. Well, 720 is pretty good. And this has happened to me dozens of times. And they've got it from Credit Karma, or they went online and they got their credit score from some company out there. But most likely it's not a FICO score. So a Vantage score is another model out there that's very popular, like Credit Karma. You're going to get a Vantage score most likely. And the three bureaus got together several years ago and they created their own score because they weren't making any money off FICO. So they sell this Vantage score as well, which is fine if you're going to get a credit card or a car loan or some other line of credit. But to get a mortgage loan, it doesn't do you any good. And it's always going to be higher than a FICO score. So a 720 on a Vantage model, maybe a 680 as an example on a FICO score. So be very careful if you're out there and you think you have a credit score and you're trying to get a mortgage loan. Make sure you get a FICO score, and you go to myfico.com, FICO, Fair Isaac Corporation. And that's the way that you get a true picture of what your score is if you're getting a mortgage loan. A Vantage score will not do you any good. So there's 5 areas that they're going to, there's really only 5 areas that they're going to look at as far as how they calculate your score. Number one, we talked about a minute ago, is payment history. If you have 35% of your score is really how you make your payments. Before I started studying this years ago, I thought it would be more than that. I thought payment history was the primary thing, which it really is. It's only 35% of your score, but that's still pretty high. The second is amounts owed. We talked about this a little bit. If you have a lot of credit card debt or a lot in debt in general, it's most likely going to reduce your scores. It may not be it may not be under 650 or something, but it won't be 800 either, because they're going to look at how much debt you carry. And it doesn't really make a difference how many lines of credit you have. Like, I have about 10 credit cards that I use regularly. But if I keep my balance 20% or less of what the credit limit, then my scores will be maximized, which would say they typically are. The third area is length of history, how long you've had credit. So again, I have a Dillard's card, I think since 1990 or 92, something in there. That's a long time. So that's another factor they're going to look at, how long you've been using credit. That's why young people typically don't have credit scores in the high sevens, because they haven't been using credit that long. The system likes to see that you've been using credit 10, 20, 30 years possibly. If you keep it on timely payments, then your scores, we see a lot of clients in the 800s. It's not that unusual. It's probably I'd say 1 in 20 have over 800 on all three models, and they're typically a little bit older people. The other thing is any kind of new credit. So if you go out and you buy a car, or you get a mortgage loan, or you get a credit card, and you have current debt, it's going to ding you a little bit, because it's seeing that you have more debt. But as you pay it down for the first 6 months of the first year, or pay it regularly, their scores will go up. New credit is not a bad thing. It's just a bad thing initially. So typically, if you were to get a mortgage loan from me and you close, and the next month you went to get a credit, your scores may be down 10 points because you have a brand new line of credit. And also, the system likes to see types of credit used. So they like to see a variety of credit: installment loans, a mortgage loan, a car loan, possibly student loans, and combination of revolving credit cards, a HELOC loan on a mortgage. I have a large HELOC on one of my properties that we don't have any debt on it, which is a positive thing, because it shows that we've used it over the years, but we've always paid it down or paid it off. So that large line of credit is a positive thing. Now, if you go, I have a client who went to get some furniture for a new property they bought, and they went to Rooms to Go or something. And he said, Mark, it's funny because we bought $4,000 or $5,000. I forget what he said, $4,000 or $5,000 worth of furniture, because they offer them the 0% financing and our deferred payments. And he said that's exactly the line of credit they gave us. So that they've maximized that line of credit when they go out and they buy that furniture. Because if you go to a furniture company, they're not going to say, here's $10,000. Most likely they're going to say, you bought $5,000. This is how much we'll give you. So you've maximized that line of credit. Okay. And that's going to hurt them a little bit. Won't be terrible because they've got great credit, but it will hurt a little bit. So getting back to payment history, a 30-day late payment, not being late. Like, I missed a credit card payment the other day. It was not 30 days late, but I had to pay them, a penalty, but I still paid it. I just missed it. So that's not going to hurt my score. It may hurt my pocketbook because it's $40 worth of penalty or whatever it was, but that won't hurt the FICO score. But a 30-day late will. And typically, I don't care what kind of account it is, the next month, your score could be down up to 50 points. Now, if you have several of those, it could be down in the 500s very fast. So the credit model looks at very current information, very current data. And the most current data is the last 30 days. So over time, you had a late payment this month, and next year, it's not going to hurt you hardly at all, because if you've made those payments timely, then they sort of discount. It'll still show up as a late payment, but your scores will be going up. And I've had a lot of clients, we've moved from the 500s to the high sixes in within 6 months, because we can somehow not manipulate the system, but we know how to play the system. And a divorce decree does not take precedence over a creditor agreement. So if you get a mortgage loan with a spouse and you get divorced and somebody takes over that property, the mortgage is still in both your names. Now, the title's been transferred, but keep in mind, if you get divorced and one party takes the property and you haven't sold it yet, that mortgage will show up on both names. So that sometimes hurts people because they don't realize that. They think that if they get divorced, then that debt is taken over by the other party. Now that may happen in revolving credit, but it certainly doesn't happen in mortgage loans. Just FYI on that one. We talked a little bit about amounts owed. 20% is the ideal or optimal. I want to talk about revolving credit lines, not so much installment, because installments are paid down over time. They're not revolving. You can't charge them back up. But again, if you had a $10,000 Visa, you want to keep it between $2,000, really no more than $3,000 at any given time to maximize your score. That's why I was able to help my client improve his score so much, because he paid it down from $11,000 to $2,000. And so the credit system says, well, he's got an optimal debt to limit, and we're going to give him a bonus for that. I think it was 20 points that we got in about a week. So the other thing about length of credit is you want to, like we talked about this a minute ago, you want to make sure you use your credit lines. You don't want to close them, because a closed card's not going to show up on a credit report. So that's sort of the basics. I think next week I'm going to come back and kind of wrap up some more information about credit models. But I hope you enjoyed this. If you have any questions, reach out to me. My number is 512-789-6967 or mark@markhairston.com, Texas Mortgage Source. Thanks for listening.